In this video, we're gonna have a look at the financials of Disney. Personally, I think that Disney is just one of those stocks where I just really like to be a owner of the stock, because whenever you see a new Marvel or Disney movie come out, you can realize that you're a part owner of that piece of content. Whenever you go to Disneyland in either Paris or in Florida, you can think, you know what, I own part of this company. Disney is a very prominent brand, and therefore I think it feels kind of nice to own a part of that, even if maybe the returns aren't as attractive necessarily. But let's actually test that statement. Let's have a look at the financials of Disney here for the past 10 years, and let's see whether or not right now the stock is attractive to buy, not just for the reasons of being part ownership of an amazing brand, but also because of the returns that you can expect from Disney here in the future. So Disney's fiscal year ends on September 30th, 2022, so that means that their 2023 annual report is coming up quite soonish. Looking at their overall revenue numbers, we can see a steady increase here of 6% annually, starting at 45 billion in 2013, which has risen all the way to 82 billion here in 2022. And even though revenue has grown by 6% annually, the moment that we look over at their EBITDA, so their earnings before interest, taxes, depreciation, and amortization, we see a less rosy picture, because their EBITDA has grown by about 0.2% every single year. Now, this may be a red flag for most companies, but I do think it's very important to realize that we of course had the COVID pandemic here in 2020, 2021, where the entire country, basically the entire world, was in lockdown. And this is especially bad for a theme park operating company like Disney. Of course, the money that they make with their theme parks is absolutely immense, and you can't even comprehend the number. But just looking at these two EBITDAs here between 2019 and 2020, you see a difference of around 6 billion in earnings, which Disney had to forego because of the COVID pandemic. In 2022, we saw that part of the world was opening up already again, and therefore Disney can utilize their theme parks once again to make an absolute killing when it comes to their earnings. And I do expect them to increase this number even more in 2023 and then again in 2024 to kind of recoup the losses that they were making during this period. So even though their EBITDA is decreasing compared to their revenue, I do think they can very easily recover from this the moment that they open up their parks and all that revenue and all those earnings start to come in. Looking at that balance sheet, we can see that their debt level has been increasing by 13.5% annually for the past 10 years, which is quite a scary number at the moment that you realize that EBITDA has not been growing nearly as fast as their debt level has. Not necessarily a problem until it starts to get to a crucial point, right? And I think for Disney, we're definitely starting to get into that territory. 13 billion in 2013, 45 billion here in 2022. We did see them already buy back some of their debt here for the past 2 years. And before that, they definitely racked up some debt. Now, of course, it's also important to realize that Disney very much focused on making Disney Plus a thing, competing with Netflix really by pushing a lot of expensive and marketable content, and this costs Disney a lot of money because they're one of the participators in the so-called streaming wars, together with Warner Brothers or Netflix or Paramount or what have you. So of course Disney used a lot of money to actually compete in that department, and this is why we see some of that debt really racking up here in 2019, 2020, in addition to the COVID pandemic. They also have quite some cash on hand actually. Most of the borrowings from 2019, the debt increase that we see here, actually remained on that balance sheet. This is just a war chest that they have available to really keep on publishing shows here for the next few years. And we can see slowly but surely that their war chest is decreasing, and so is their debt level. Market cap is the value of the stock as seen on the open market itself. So we take the stock price and we multiply this by the amount of shares outstanding. We see here 116 billion in 2013 and 174 billion in 2022, whereas in 2021 we see an absolute massive market cap of 314 billion, which is almost halved here in 2022. Definitely interesting. We can definitely have a look at this compression of the multiple and see whether or not we think it's a buying opportunity for us here in the future. Enterprise value is the entire value of the business. So this is when we look at the price on the open market itself, so the market cap, and we add the debt and we subtract the cash, and this is how we get the enterprise value. EV/EBITDA is the amount of years of EBITDA it takes for Disney to buy back the entirety of their enterprise value. And we can see that the multiple that they've had here was actually fluctuating quite a bit. 11 times, 12 times, 12 times, 10 times, 10 times, 10 times, and then we start moving up higher. 17 times, 31 times, 43 times for a company that's been decreasing their EBITDA here for the last 2 years, which I think is very, very interesting. I think this was a very weird year for Disney, where their earnings were decreasing, but their multiples were increasing like crazy. This valuation has come down a little bit once again in 2022 to about 18 times, which gives us an average of around 17 times for the past 10 years. Net debt to EBITDA, like I mentioned, they had basically no debt in the initial parts of the decade, but for the last 4 years they definitely racked up quite some debt to compete in the streamer wars, but also to account for the fact that COVID took away a lot of their profitability and they had to leverage up a little bit because their earnings simply wouldn't sustain this number. This number is mostly influenced, I think, by the fact that their earnings has halved and not so much by the fact that they took on a lot of debt, because they can afford 53 billion in debt with the earnings that they had in 2019. This then brings us over to the cash flow statement. Their cash flow from operation was 9 billion in 2013, 6 billion in 2022. Once again, influenced mostly by the COVID pandemic. We did see a very high number of cash flow here in 2018 of 14 billion, and I do expect them to slowly but surely crawl back towards this number. Capital expenditures, all the money that they have to put into the business to kind of future-proof themselves and keep on operating their business in the future as well. We're talking about additional rides in Disneyland. We're talking about additional shows on Disney Plus. We're talking about additional company events, an additional brush of paint. Anything that you need to keep on future-proofing your business is included in capital expenditure. And we can see that their capex has been steadily increasing by 6% annually for the past 10 years. About in line right now with cash flow, but once again, I do expect the cash flow to actually move up quite a bit faster than their capital expenditure. The moment that we take the cash flow and we subtract the capital expenditure, we get the free cash flow, which is your pro rata ownership of the company. This is all the money that's available at the end of the fiscal year to do with as they please, to reward shareholders mostly. So we're talking about buying back shares, we're talking about dividends, we're talking about buying back debt, and we're talking about additional acquisitions or expansions. Of course, Disney is expanding their online portfolio when it comes to their Disney shows, their movies. They're also expanding some of their operations in their theme parks, and they're also buying back debt, as we have seen here for the last 2 years. For the last 4 years, there's not that much free cash flow to speak of, so they also stopped paying a dividend, I think in 2018 or maybe slightly before that. For the past few years, they have not paid a dividend, but maybe once their cash flow starts to increase again, they can actually think about reinstating that. I definitely think that they will. Their shares outstanding have remained fairly neutral here for the past 10-year period. We saw in the initial part of the decade they started to slowly buy back shares, but the moment that COVID came around, they actually had to dilute those shares to do some additional fundraising, in which they diluted the share count for the investors to raise some additional capital. Free cash flow per share has also been decreasing by 17% in line with free cash flow because the shares outstanding have remained the same. We see some very high numbers here of $6.50, but also some lower numbers of about 58 cents here in 2022. Share price, like I mentioned, is a bit of a roller coaster here for the past 10 years. $64, 102, back to 99, up to 172 in 2021, an absolute massive year for them, and then it's decreased back down to about the $100 range, a number that Disney has seen several times before. Free cash flow yield on average around 3.4%. We see very low numbers here for the past 2 years because their cash flow is so low, but prior to those low COVID years, we saw yields of around the 5% mark. So this then brings us into the business of trying to forecast Disney into the future, which is a bit tricky because I have to make some assumptions here on the profitability of their theme parks, because for the past few years we have very bad estimates when it comes to those numbers. But analyst consensus right now is that they can actually manage to go back up to 15 billion in EBITDA in 2023, which is still well below their peak number of EBITDA in 2018, where it was 18 billion. For 2023, they expect 15 billion. So I'm going to go ahead and agree with that number and then move it up to 19 billion in 2024 as they can recoup all the losses from their theme parks, keep it operational, really have this additional stream of income come in. Also, Disney Plus is about close to becoming profitable, so we can also see an additional flow of income from their streaming platform, and I think for that reason we can probably see a higher increase in EBITDA, maybe in 2024, maybe even a little bit later, but definitely somewhere in the future, I do believe. So I'm going to give them 25% here for the 2024 numbers. Afterwards, I'm going to grow it by 8% annually, which is about the average number of growth that we've seen here prior to the COVID dump. And I'm going to grow it by 6% for the last 5 years, because I'm not sure what the future will hold. But a growth of 8% in earnings is quite lucrative for any business, so I think to reduce that to 6% is only fair. I'm also going to attach a multiple of 16 times, which I think is relatively high considering their history, but they've also seen a high of 43 times and a low of 10 times. I think to be a bit more in the middle and look at their average numbers, I think 16 is a nice conservative, but still somewhat accurate number that I can probably expect here for Disney in the future. This gives me an enterprise value of 512 billion, from which we then subtract the debt, we add the cash, gives us a market cap of 478 billion. Divide this by the amount of shares outstanding, and I'm assuming here that the amount of shares outstanding remain the same. This then gives me a stock price 10 years from now, so for 2032, of $262.15. And I'm going to do the same here for their free cash flow model as well. I'm going to grow it by 50% for the first year and an additional 50% for the second year as well, to really recoup the losses and to really bring it back to the about 2018 numbers, which are numbers that I do expect them to hit again once they can get their theme parks operational. I'm going to grow it by 8% for the 3 years after, and again 6% for the last 5 years. I'm also going to attach a free cash flow yield of 4%, which is a bit more conservative than their overall average, but I do think that these last two numbers definitely skew the numbers a little bit here. So I'm going to be a bit more conservative, maybe even 4.5 if you want to be really conservative to, nope, not quite. To be really conservative, because the moment that we normalize these a bit more, you can already see that even 4% is well below their 10-year average. So I'm just going to give them 4.5% to really have that level of conservatism baked into my projections, to have that additional cushion in case something goes wrong. Looking at the open market right now, I can buy as many shares of Disney as I want for $88.10, which is definitely a low point here for Disney for the past maybe even 10 years. Let's have a quick look here. The lowest number was $64 10 years ago, and before that they definitely reached the lowest number, because even in 2014 they had a share price of $89. So the current share price is lower than it has been for the last 8 years. So definitely a low point here for Disney. Taking both our projections, so the enterprise value as well as the free cash flow model, I get an average share price 10 years from now of $214.85. Simply looking at the price on the open market itself, I expect a compounding annual growth rate of 9.3%. But the moment that we actually include the free cash flow that I projected here on the free cash flow model, I get an internal rate of return of 15.5%. On average, the market returns about 10%. So I think compared to the overall market, I think Disney will perform about in line, maybe slightly outperform the market here. But of course, this projection is very much predicated on the fact that I do expect Disney to recuperate their earnings loss that we have seen for them in the past few years. And of course, if this does not happen and their earnings are still quite low, let's say 12 billion here and let's say $2 free cash flow a share for the free cash flow model, we can definitely see the returns diminish quite steadily, quite fast. So definitely take that into consideration. I'm assuming that Disney will actually up their earnings back to where they were prior to COVID, but this might not happen, right? Take that into consideration. So let's see what happens if the price goes up or comes down a little bit. So the moment that the price goes down even further to $63.43, I expect an IRR of 20.9%, which I think is very attractive and definitely a price point where I would pick up Disney Of course, not only for the intellectual property, just knowing whenever I see a Donald Duck or a new Marvel movie that I'm a part ownership of that intellectual property, but also because it can actually give me a proper return here in the future. The moment that the price goes up a little bit again, once again to about $115, I am no longer really interested in Disney. It gives me a market consensus return based on the projection that they will actually re-establish their earnings, which is still not set in stone, right? So I think there's a lot of risk involved in buying Disney the moment that they get to the price range of around $115. Thank you very much for watching. Don't forget to like, subscribe, and all that good stuff, and I'll see you in the next one. Cheerio!